Hello, Nick. Welcome to the Builders Podcast. It's a pleasure to have you here. How are you today?
Thanks, Michaela. It's a pleasure to be here. Really appreciate you hosting me.
Nice, nice. Would you like to give us a little bit of introduction of yourself, your background, and of course, Sidecar as a company?
Yeah, of course, happy to. Um, my background starts with me as an illustrious corporate lawyer, working at larger law firms in New York and the Bay Area, where candidly, for most of that time, I was questioning my life choices. But along that journey, I learned the value of rigor and grit and hard work and just operating at a level of excellence because that's what clients who are paying large law firms expect from those working on their matters. Um, and as a corporate attorney, I got to work with amazing founders, amazing VCs. Specifically, at my time on the West Coast in California, I worked at a firm called Cooley, which is very well known for its work with startup companies, incubators, VCs, the whole startup landscape. And I built a really great set of relationships there with some amazing founders in Silicon Valley. And as you know, Michele, founder stories are infectious. The minute you hear about what some founders working on, you're like, how can I help you? How do I get involved and kind of shift some of my life focus to give you some of my energy to further your mission? And I found myself gravitating to a lot of founders in my ecosystem. Long story short, I started investing behind some of my founder clients, just personal checks at first. Then I teamed up with the individual that became my co-founder at Sidecar, and we launched a small fund. We launched a micro fund to back some of those founders in later rounds, but also other companies in our ecosystem. And it was along that path of becoming a venture capitalist that I realized how painful it is for those that aren't corporate lawyers, who don't have a background in structuring, to think about launching their first SPV or their first fund to invest in something they care about. And when I realized how painful that was, I started to take off my investor hat a little bit and put on my own founder hat. And I thought, there is something interesting here. The entirety of private markets operates through fund structures, partnerships, and the processes involved to set up these funds and maintain them for their lives is not that different from one another, depending on how these funds are set up. The mechanics are actually pretty simple. However, there's a lot of complexity in how people design these funds when they're creating them. And it's thanks to people like myself, thanks to lawyers. And I figured if we could standardize how SPVs are formed, how basic funds are formed, and we could decrease the cost of entry for those who want to become a venture capitalist, and we could also make it so that deals that are otherwise uneconomical because they're too small, they could happen because they could be powered by software where the fee to create the investment is much lower because we can standardize all of the processes along that journey. So in early 21, I decided that this would be my life mission. Co-founded Sidecar. We automate the creation of SPVs and turnkey funds for venture capitalists. We've been in business now for almost 5 years. We've worked with thousands of sponsors, and we've moved over $3 billion through the product. And it's been quite the journey. I've learned a lot, as I'm sure you talk to other founders on this podcast and elsewhere in life. Like you learn a lot, and it's not linear. So happy to talk about anything and everything.
Yeah, first of all, it's absolutely not linear. But I also strongly feel about the first kind of couple of things that you said. So, a lot of people in this work, mostly if they're coming from, investment banking or lawyers background, corporate background, they end up sooner or later questioning a little bit of their life choices and everything. And when they got in touch with, the entrepreneurial side, startups, founders ecosystem, and everything, it's a one-way ticket to hell, basically, and you cannot resist that kind of call. But yeah, I totally agree on the second point. So handling those kind of SPV and handling those kind of vehicles over time is very frustrating, a lot of work, and almost zero value added if you are doing that on your own, because you just take it as a management, as a bureaucratic thing, to do. Instead, there are a lot of value that can be taken out of those kind of processes, and I think it's very interesting on trying to make them a little bit easier for fund managers. But I would like to start to talk about the first part of your career now, when you actually started doing a little bit of venture capital and investment on yourself. Um, how did you find that kind of way, in your life? So how did you start at that? How much did you enjoy the couple of deals that you made? So how it was going before you started your own company?
You know, when I was in New so prior to moving to Silicon Valley, I worked at a larger firm in New York City, and I would spend a lot of my free time reading TechCrunch, right? And just dreaming
Mm,
about being closer to the tech ecosphere where it seemed like anything is possible, right? I mean, you can make magic
mm,
happen with creative minds and capital and just the energy of the Bay Area. So when I moved to the
mhm,
Bay Area, I actually was on a pursuit to find things to invest in.
mm.
And I was like, hi, the next Google is being created here. And I'm
Yeah.
working at a law firm that very likely represents that next Google. How do I meet these people and then invest behind them? So it was easy for me to make the decision to invest. Candidly, when I worked at this larger law firm, Cooley, I could not invest behind my clients because of
Mm,
conflicts. I ended up starting my own firm. I kind of left this part out of the journey because it's a little less relevant to the sphere, the arc that goes to
mhm,
Sidecar. But I started my own law firm after leaving Cooley, and that's where I had a chance to build with about 30 founders, and I could do what I wanted as far as investing behind them as long as it disclosed all the conflicts and whatnot, right? So
mhm,
that's when every time I met a founder that I thought had a spark that I was interested in, and seemed like they knew what they were doing. And, I started to pattern match what great founders look like. And it really came down to consistency and rigor and team building, more than just like how they tell the story and the creativity behind it. But when I found those founders, it was easy for me to make the decision to invest behind them. And I said, I don't know where you're going to go. The business you're pitching me
mhm.
today might be different in a year, but I believe in you as someone that will take a mission forward no matter what and will persist because persistence is so important. As we talked about the non-linear journey, I kind of knew that
Yeah.
having worked with many founders before. And I wanted to make sure I found those founders that would never give up, that were just relentless. And that's when I would write the check. I hope that makes sense, Mikhail.
Yeah, yeah, but that makes a lot of sense. Not stopping, no matter what, it's kind of a very good point. And coming back to the other side of the medals, when you actually were investing and when you actually saw the kind of gap in the market, where do you think, those kind of emerging managers will find the most challenging, the biggest challenge there? Because basically I've been speaking with a lot of fund managers, and they usually comes from either, a VC background or an investment background. They've used to bigger funds and bigger firms and a lot of money to handle. And then they start doing something on their own and they realize that a biggest part of this job is actually managing bureaucratic things and, setting up things. And it's very annoying, that part. So where did you actually understood that that was a problem that many people out there were facing?
I realized that pretty quickly. I think the investor story, as far as raising capital from other people
Mhm.
and uh, investing in companies that you believe in. I think that story starts at it's really a sales story, right? Because you have to sell
Mhm.
your prior history. You're selling yourself as a VC, right? So Michele, you're selling
Mhm.
Michele, I'm selling Nick to a
Yeah.
bunch of people who will trust us to say, you will find a company to invest in that I want to back, and I'm
Mhm.
investing in you to find that asset. And then you have to wear another salesperson hat, which is when you go to these founders and you say, hey, you should take my money over someone else's money. Chances
Mhm.
are, if you found a really great founder building a really great business, there's competition for that deal at some point.
Yeah.
Maybe it's not on day one when you meet them, but when other people realize why it's interesting, you may still have to compete for an allocation. And then that sales process is really around how much you will fight for them and why your approach is differentiated, and you will help them overcome some obstacle in the future, because usually as an early VC you're not promising to give them hundreds of millions of dollars in later rounds. You don't have that capital, but what
Yeah.
you can do is you can fight, right? You can show them that you will show up, you have contacts for them to help them grow, you've been on this journey, you understand their trites and tribulations that will come, and then you will help unblock their path for them. And then once you've gotten the allocation, then you have to figure out how to structure the transaction, right? This is where the
Mhm.
bureaucratic process starts of like, hey, what type of structure do I use? Is this a single investment I'm making? Because don't have a fund yet, and I need to create an
Yeah.
SPV, right? Or do I already have a fund? And is this pretty simple? I got to talk to my administrator and they'll figure it out. Or hey, maybe this investment doesn't fit my fund thesis. I need to create an SPV anyway, although I have a fund. And that's where the bureaucracy comes in. At least it came in for me as an early VC, where I realized, hey, this process of creating a vehicle, opening a bank account, having to go contact 20, 30 investors in my Rolodex and say, hey, here's what's interesting. Here's a link to subscribe. here's another set of instructions to send money to, and then go and chase them for like a month, right, to get all this
Mhm.
stuff done.
Yeah.
Meanwhile, talk to the company as I say, hey, it's coming, it's coming, it's coming, right? Because I'm working with 30 different people at any given moment. That was a bureaucratic process that I didn't like. And I felt like, hey, there's just more pain upon pain upon pain. This journey's hard
Yeah.
enough as it is, right? To raise capital and find founders worth investing in. Um, and I realized that, we could kind of take away all that pain of creating a vehicle, opening a bank account, having people subscribe, reconciling all the capital, and then maintaining the taxes and reporting for that vehicle over its lifespan. Right? That's where software could really come in and help. What we offer at Sidecar ultimately is picks and shovels, right? We're not helping you do what's really interesting about your job, which is finding the companies. That is the magic, the spark that VCs bring and what people are investing in. But we try to take away as much of the other pain as possible so you can focus your energy on the things that actually create
On what's
value.
important, basically, in the end. Yeah.
Yeah.
And so recently there's a huge wave of emerging managers. There's a lot of people actually thinking of starting their own funds, or starting angel syndicates and any other kind of organization that are going in that direction. Uh, what do you think, you know, it's important for those kind of people to understand when starting that journey. So let's suppose that you have, a classroom of emerging founders out there. What would you be, the first advice that you gave them, and how would you guide them on starting their own first fund right now in this kind of environment?
I think I would number one ask these individuals to really think deeply about what's
Mm,
motivating them to start the fund. Um,
mm,
and if there's any aspect of vanity or wanting to do it because someone else did it, to try to remove that from the equation and then think, do I still want to do this? Because it is a
mm,
hard journey. I would then suggest that that group of people think about the founders that they would invest in. Right. What are the
mhm,
qualities of those founders? I mentioned grit, perseverance, just a relentlessness, because I think that's important in founders. I think it's almost 200%, right? As important in VCs, because like I mentioned, raising capital as a VC is not around a business plan or a vision for a business and how you can build a team. It's you, right? You're
mhm,
selling McKellar, right? And that is
mhm,
it's not to say that McKellar is not worth investing in. But when you're making that case, it's harder than just saying, hey, here's
yeah,
a business plan you're investing in. Here's how you can tell you the story of a 5-year journey, right? So do you have that relentlessness and that spirit of, you know what, I'm going to get told no 300 times before a single person says yes? And is that something that you're still excited about? And if you have that relentlessness, then please go ahead because you will succeed.
mm,
But you have to have that spirit, that drive, that motivation because it is harder to raise capital today than it was a few years ago. And I think it's
mhm,
appropriately hard today. It should not be easy to be a venture capitalist. It's a
yeah,
privilege and it should be hard. And if you succeed, it's because you're really great at pattern matching or you're lucky or both. And that journey is not one that I think is for everybody, right? So
mhm,
um, I think like with anything, you see like there's a top of funnel, right? Even for startups or for sales, for anything, where there's thousands of prospects, then as you go down the funnel to success, it gets leaner and leaner and leaner. I think in venture, it's a very wide funnel, right? Because it's so hard. Um,
yeah,
that said, what we aim to do at Sidecar, and I think what's interesting is you could test out your hypothesis of whether you have a good strategy for the fund before you raise that fund by running
mhm,
SPVs and investing in companies that you have access to, and treat that as your track record because I think that is the most important thing you can point to is what have you done in the past? And unless you came from some legacy fund, a multi-billion dollar fund where you can say, hey, I invested in a company that's now 200x where I invested from, right? You have to start to build those proof points yourself. And I
mhm,
think that starts yesterday. You got to start doing that. If you haven't done it already, start doing it now. There's no cost to you really in validating your hypothesis, and that is the best lever you can pull to justify why you should be ABC.
mhm. And do you still think that, one of the most common things, most common path, let's say, that people usually take is, starting from either business angel investing or, for example, running a syndicate, smaller kind of organization before starting a fund. Do you think that it still makes sense today with all the kind of tools, with all the kind of things that are out there?
I think so. I think it's a very logical path. Um, what we see is there's a few different like archetypes of venture capitalists. There are those who are career VCs. So, you know, they joined a large VC at some point. Maybe it's after founding and exiting a company.
Mm-hmm.
Maybe it's after grad school or having worked at a large company and being visible to a board member who happened to be a large VC. And then they get picked up to work at that VC, right? And these are I'm talking about the multi-billion dollar VCs, right? The
Yeah.
Andreessens and Bessemers and Lightspeeds. You work there for some time. You prove yourself. You become a partner. You
Mm-hmm.
run deals. Those deals do well. You're visible to LPs at those funds. And you step away with 60 to 80 million dollars already underwritten for your fund. So your fund one's basically done. You've already
Yeah.
raised it before you left. That archetype is very different from what you're talking about, which is, hey, I'm starting as an angel investor and I'm
Yeah.
working at an accelerator and incubator. I'm working with the grassroots of the startup ecosystem, and I'm proving myself by investing in companies before anyone else even notices them. I think the issue with starting there that's different from starting at a large fund is
Yeah.
number one, you're not building relationships with institutional LPs early. You're building relationships with individuals who might be writing 25 to 100K per investment.
Checks. Yeah.
Um, and the second thing is your Rolodex of founders is somewhat limited to where you started your business. Whereas if you're working at a very large fund, you likely are interfacing with founders already at that fund who will open up other networks
Mm-hmm.
for you. So you tend to see a different type of deal flow. It doesn't mean you shouldn't be a VC. I do think it makes the journey to raise, let's say, $100 million much harder, much, much harder. And I
Mm-hmm.
think if you accept that, it's actually a more interesting journey. It's a more, I would say, it's like a more honest and like like self-earned journey into venture capital because you're proving at every little level of like what you're great at. Maybe your first fund's $10 million, and it's just as hard to raise as the legacy VC partner's $100 million first fund. But I think it's more interesting because the more that you do well, the more you actually stand out in the ecosystem because it's much
Mm-hmm.
harder. But I think that it is a harder journey. I think where most of those individuals end up is they end up remaining as deal runners, if you will, basically like finding founders, investing in the things they care about, and forming angel syndicates and other groups that invest together rather than raising a fund, because raising a fund is so hard. So what we're seeing is those standouts who want to raise a fund, they actually end up building really interesting communities, and they find ways to engage those communities around content, around deal flows and activities that relate to deal flows, around supporting founders and building maybe media-like businesses rather than just focusing on the fund. But
Mm-hmm.
I think it's actually quite interesting. It's a cool business to be in. And we think the future of venture looks a lot like that. I mean, that's why we
Yeah.
exist. Because we think that those who start the first $100 million fund, there are fewer and fewer of those, and maybe they're harder, right, to do over time also. Because it is easier to invest in deals now, given that it is much easier to become a first-time VC and to like find an interesting company to create that media side of the business. And as a result, there are more individuals in that sphere than those who are starting the $100 million first fund. And we think that's a
Mm-hmm.
very good change for venture because venture is all about, those sparks of creativity
Yeah.
and, and that's where those sparks typically take place.
Yeah, there's a whole, let's say, trend about media for VC that is going on at the moment that is taking place right now. And on top of that, I would say overall, there's different kind of models, VC models out there that are, being tested today. Compared, for example, to 10 or 15 years ago when basically everyone was running the same exact model. 4% management fee, 20% on the results, and that was it basically. And no one was trying anything different. You just had to fight for the best deals. But right now you see many different kind of different format, different models, different way to do this kind of works over time. And it's very interesting how this kind of market is reinventing itself over time at the moment. Also because of many multiple different kind of variables, from liquidity,
Yeah.
from interest rates, from geopolitical motivations and everything else. So it's very interesting to see what is happening. I do believe that, and I totally agree with you when you say, earning that firsthand without coming from that kind of environment is a much interesting journey. To be honest, it's very very interesting, and I know a couple of people that are trying to do that. It's 100% harder, absolutely, but very very interesting journey.
Yeah.
Yeah,
Yeah. It's the hard things are usually more fulfilling in the end, right? Because
yeah,
it's usually not the result of the work that's as interesting as the work, but I think as humans, we tend to gravitate to the result as what drives us forward, and we
yeah,
sometimes miss the opportunity to enjoy the journey. But
yeah.
that journey is way more interesting, right?
It's
For someone
absolutely a
that
good
has to
point.
work hard for it.
Yeah, and you're focusing only on the US right now, or you're also expanding outside?
So the limiting factor for us that we've intentionally chosen is we only create vehicles in Delaware, in the
Okay.
US, and as a result, we tend to be more US focused, but we do have, I think, about 25% of our business is from GPs outside the US and deal flow outside the US.
Hmm.
So Delaware is
Nice.
actually a pretty good jurisdiction for investing across the world. So
Yes.
we do see a
Yeah.
decent amount of cross-border stuff.
And it's very, very common also for people from, Europe or India or Africa to, set up companies there to invest on other deals.
Exactly.
Um, and, on top of being on the probably best startup ecosystem ever, it's kind of easier to just focus on the US. So
Yeah.
it makes a lot of sense. There's a huge right now, let's call it topic or conversation or discussion around, how to actually set up something that is very, very similar to what you have in Delaware, with the kind of organization that you can open up in Delaware to run a company or run an organization, actually to shift that into Europe, with the AU Inc. That is a very, very interesting project that we are trying to launch in Europe, and we are still not able to do. So there's a very, very similar concept that I think that could potentially be a game changer here. That would be very, very interesting, and also potential, steps for you to expand abroad, to do something very similar. But I think that having something that is so useful, like the company setup that you have in Delaware, it's actually uh, you know boosting up the environment a lot. If it's so easy to set up a company, if it's so easy to invest in a company from that kind of entities, everything else that get a little bit easier. And the first step, the barrier to entering the market is actually getting lower and lower every time. So that is something in my opinion is very useful that a lot of countries out there should copy, to be honest. Not sure about your experience with that and your experience abroad, but that is absolutely something that I invite you right now.
I totally agree. We, as I mentioned, we have customers outside the U.S. also, and many of those customers want to invest in, let's say, entities formed in Germany or Israel or
Mm,
India or elsewhere, where there are a lot of hurdles to even
yeah,
invest in these companies, right? Where you have to create uh, or register certain accounts with certain agencies just to be an investor, and
yeah,
it's tedious. And it acts as a barrier to investing, which is probably not ideal for those local companies, which is why I think a lot of these companies do form outside those jurisdictions, right, to raise capital. I don't think the things that we do are that interesting along the founder or investor journey, but they shouldn't be hard, right? Because the interesting stuff is what's hard. It's the relationship side of the business. So yeah, if there's movement in Europe, do you think it's interesting? I'd love to talk to you about that as well.
yeah. That's. I think it's a very interesting trend going on right now. Still not sure if we will be able to pull it up, to be honest. But at least it's something is moving under that point of view. Coming back to your experience in those kind of things, I saw a lot of very interesting trends about the size of the fund that are being launched every day, with funds being from one point of view smaller and smaller, going to the micro size of funds, with a lot of statistics confirming that micro funds are returning better returns over time, and at the same time going in the totally opposite direction, in the direction of mega funds, billion and billion of dollars in the in AUM, and basically nothing in the middle. So the usual 100, 200 billion size seems to be disappearing a lot. I'm not sure about your kind of experience on numbers itself, but how do you see that kind of trend?
It's funny when we started Sidecar, I had drawn a like a bell curve chart for our team, and I said
Mm,
here, like if there's venture, and this is, let's say, I don't know what side you're looking at, but let's just assume this is the small size and this is the big size,
okay,
right? It's not a bell curve. It's like a spike and another spike.
another spike.
And if
Yeah.
anything, it may even continue down that trend because it's it's really about for me following the money, right? So
Mm,
um, if you're an institutional LP
mm,
and you're investing minimum, let's say 25 to $50 million into funds, are you going to try to be the maverick and find
mm,
that $100 million fund to anchor and take a huge bet on? Or if you're just a salaried employee at one of these institutions, would you rather just do the tried and true? I'm going to invest in the multi-billion-dollar funds that have like 20 years of track record, right?
yeah.
You're more likely to
It's an
kind of
easy
chase the
question.
multi-billion-dollar side, right?
Yeah.
Because that's just safer. And then if you're the high net worth individual, typically writing 5, 10, 20K checks, right? Are there enough of you to justify raising the $100 million fund? Is because it's a really hard journey to get there,
Mm,
right?
yeah.
So you tend to see that these people who start with the ambition of becoming a $100 million fund end up just raising a $20 million fund and then running multiple $20 million funds for this exact reason. It's just like you follow the
Mm,
money. There aren't enough institutional LPs who are mavericks. There are a lot of people who want to invest in VC. And the more people that enter this wanting to invest in VC sphere, it's actually interesting. A lot of these people want to even have discretion. Like they're like, hey, like I heard about
mm,
X company. Can you get me more of X company? Right? And that means that you're necessarily becoming less of a VC and more of a syndicate lead, right? So
yeah.
it's just kind of like how the money flow seems to be working in venture capital.
Mm. No, it's an interesting topic. Sometimes it seems that we're also acting as an intermediary more than an investors. Just getting in touch with the right people, getting on the right kite table, instead of actually investing for them. And yeah, that happens a lot, to be honest. I was wondering about there's a huge discussion, and probably the word of the last 2 years is basically around AI and the use of those kind of technologies in everyday works. So I was wondering how and if, of course, do you actually use AI in your day-to-day jobs to actually set up those vehicles, to actually write agreements and everything that is working around in the setup of an SPV.
Yeah, it's a super interesting topic. Today, AI does not play a critical role in how we set up our
Hmm.
vehicles. And a part of that is by design. We want to be 100% accurate and deterministic around the relationships in each of our SPVs and all of the
Hmm.
reporting that comes later. So that necessarily means that, we're not applying AI to interpret a form or an agreement that we didn't create and then give us some sort of probability of accuracy for how that legal relationship or economic relationship should be defined and written into stone. Um, that may be the future, but we found that our success lies in creating standards, kind of like creating Lego
Hmm.
blocks. And as a result, AI is not that useful in like creating another Lego block, you know, just software is, right, in general. Where AI has been super useful for us is in the jobs to be done around creating the SPV. So
Hmm.
in relating to our customers and helping them unblock, right, issues as they arise. In thinking about the user flow for how someone might create an SPV and share it with their ecosystem, like gathering interest for an SPV, drafting, customized outreach to their investors to share why a deal might be interesting based upon historical investments an investor has made. reporting information, collecting and reporting information, and branding it, right? Those jobs are where it's interesting, and we have a lot of good stuff on the roadmap that we're excited to share with the world in that realm. But around what you asked specifically, we haven't found AI to be super useful for us.
Hmm. You know, 2 points about it. First of all, you're probably in the last 30 episodes the first person that is not saying, yeah, AI is central for us. Everything is going around AI. So probably you're the first one. And yeah, I say in a positive way. And second point, I think it's a very interesting concept of having, those kind of legal blocks established by a human and not an AI and not a computer, so that you can actually build on top of them over time. So maybe everything else can be done also by a computer over a long period of time, but at least the basic, the foundation of what you're trying to build has been done by a human and has been verified by a human. So that is a very very good point. On top of that, so I understood that you also provide basically other service on top of the constitution of the SPV. So you also help them get in touch with LPs, help them making cold reach, everything about actually fundraise that first fund, not just setting it up.
That's right. So there's an element of what we do. And again, we don't have a marketplace, so we don't
Mhm.
identify LPs for you. But when you bring your LPs to Sidecar, we help you in sending out the communications to them about the investments you're making and
Yeah.
to remind them to take actions on that they need to take, like to subscribe or to fund or et cetera. And that's where I think there's a whole world of opportunity around customizing how that works and being more creative in that type of a relationship than
Mhm.
where we are today. But we do try to take as much of the work that is painful away from the GP so they can focus more on investing behind deals that they care about and not just doing the, like you mentioned, bureaucratic work of chasing people for
Mhm.
signatures or for wires.
Yeah. Not non-added value work basically. So everything that is not adding value to the table, you try to take it away from them,
Exactly.
and that makes a lot of sense. I was wondering also about the kind of differences that you find on actually fundraise for a fund and fundraise for a startup, because I think that you have been through both of them right now. So you felt the pain on both sides basically. So how was it?
I mean, it's way harder fundraising for a fund. Way harder,
Oh,
like an
cool.
order of magnitude harder raising for a fund. Raising for a company, um, look, there are people out there, VCs, whose entire job is to give you money, right? They're looking for reasons to give you money. Now, it's counterintuitive because if you're a founder, you think it's really hard to raise money, and I have to go and get told no a bunch of times, which is true. But we have to also remember as founders that there are people whose job it is to validate that you are what you say you are, and they want to give you money because it's their job to deploy capital into you,
Yeah.
right? So, but if you're a VC and you're raising your first fund, again, you're probably not pitching to institutional investors who have that same job to give you money. You're pitching to people like you and me. And we're much harder to convince to give you money as a
Yeah.
VC than a VC is to convince to give a company money, right? So,
Yeah. First of all,
yeah,
because I don't need to. If I want, I can also say, okay, no, I just want to invest by myself. The VC cannot say that. They need
exactly.
to deploy money in the end.
Exactly. Yeah, so it's much harder. I will say from the fundraising journey as a founder, what I've found most helpful is to raise capital when you don't need to raise capital. And
Mm.
because when you need to raise capital, now you're at a mercy of runway,
Yeah.
optics in the business, and how you're doing, right? Performance expectations you have to hit for someone to think that, hey, this is really worth investing in. And then, there's an incentive to maybe draw out the timeline a little bit, right? If you're a VC,
Mhm.
unless it's very competitive. But if you don't need to raise money and you're doing really well as a business, it may not be intuitive to raise money. But you're better off taking money when you don't need it as insurance and
Yeah.
then continuing the journey forever than raising it when you really need it. The terms tend to be better because you don't need it. So you can negotiate longer and you can say, hey, I don't really need you. And you know what? The thing that gets people most excited is when they feel like you don't need them, right? That's when they want it more. So you got to play into that psychology a little bit, not in an abusive way, but I think it's a prudent way, right, to raise capital. So I would say for any founders out there, If you're early, you don't think you need a raise, maybe now's the conversation to ask for help and advice and guidance from people you want to be on your cap table. And if they ask you if you're raising, I would actually say no, you're not raising, and then see what happens.
Nice. That's an relevant advice, to be honest. Just say no. It's something that a lot of people out there cannot, afford to do, unfortunately. But if they can, it's a very good advice.
Yeah.
No, yeah, but it's very very interesting, to be honest. And I was wondering, in the beginning of the conversation, you said that you started in New York City, if I remember correctly, as a corporate lawyer, and then you moved to the Silicon Valley. I was wondering about the kind of differences between, the two sides of the US in terms of startup ecosystem and everything else.
Mm.
There's this huge myth around Silicon Valley that is probably true and not just a myth. But there is also a very very interesting startup ecosystem in New York that is probably among the first three or five in the world probably. So I was wondering about your kind of experiences and the kind of differences that you saw in the two, side of that country.
Yeah, I- as you said, they're both excellent places to start a
Yeah,
business if you're looking
for
to
sure.
to try something new. I would say Silicon Valley definitely still has more of a culture of experimentation, and
Mm.
I would say like the art of the possible. Whereas I think New York has a bit more pragmatism in like what you are doing and whether it's valid and can turn
Mm.
into a real business. I think in Silicon Valley there are still a bunch of people who are chasing the future for humanity, for the world, for maybe even for beyond humanity and the world, right, into space and beyond. And that's an interesting way to think about sort of the evolution of what capital can do to kind of like take us to the next chapter, which you don't find as much of in New York. I think in Silicon Valley there's still a lot more
Mm.
ideals and excitement and passion um, around how technology can just entirely revolutionize how we do things. Again, in New York, I think it's more of a practical application type of exercise of like, all right, there's all this great tech. We have these old industries that are archaic. How can we apply it today to create value? Not
Mm.
saying that you can't do that in both, but I think if you're trying to do something truly experimental, try to find either an industry specific place to raise capital. So for example, if it's energy, it might
Mhm.
be, let's say, Texas or a state that has a large energy ecosystem. If it's space or something else, maybe move to the Bay Area where you don't even need to have a business model yet for how you're going to raise money. It could just be on the technology alone and why it's groundbreaking. Whereas in New York, I think you have to have more practical application for how the technology will to um, for lack of a better
Impact,
word,
basically. Yeah.
disrupt some sort of ecosystem that exists
Mm-mm-mm.
today.
Yeah, no, it's a good point. I think that New York and that perspective is more in line with, I would say Europe, where we actually try to find very pragmatical solution to everyday problem, and not just think about the future long term like that. Coming back again to the beginning of your career, where you were a corporate lawyer. I was wondering about the impact of AI on that kind of work. We saw many different kind of companies and startups today actually applying AI to the corporate, the lawyer world, basically, and the law world overall. And I was wondering, have you ever thought about your kind of first years and first experience in that world, and how would you use AI in that sense, and the kind of impact that can have? Do you see your old job disappearing anytime soon, or not?
I hope so. Not to say that there shouldn't be a path for early attorneys, but the jobs that I would do as an associate, uh, growing at a law firm, man, there's so many jobs that don't need to exist. I would
Mm.
spend a lot of my time word processing, literally taking someone's hand markup of a document and then interpreting what they were trying to say with their really poor handwriting and then creating another version. And they asked me to do it and not a paralegal so they could train me on
Mm.
how to kind of revise documentation and the logic behind it. But so much of that could have been training in a different way rather than just being a word processor, right? Literally just like
Yeah.
taking a markup and changing it. I spent so much of my time also starting with precedent. So like, let's say I had to draft bylaws for a new company. I would
Hmm.
go to bylaws for another company, literally just find and replace a bunch of terms and then spend about 10% of my time thinking about how is this company different and what are things that this team might want different in the various rules and not rules, but the relationships defined in the bylaws, right?
Mhm.
I'd rather I spend 90% of my time thinking about that instead of 90% just modifying documentation, right? So I think AI
Yeah.
has a lot of opportunity here to change how people spend their time. And, as far as the people doing the work, they'd be very aligned with AI taking that work. I think a tricky part in law is that law is still billed by the hour. So the law firm
Yeah.
incentive
Yeah.
to
It's a
take an
good
hour
point.
and make it 5 minutes is a little different than how I might think
Mm.
about it, right?
Yeah.
Um, that said, we're still seeing a lot of companies come into the legal tech field, legal AI field, and really disrupt how law firms operate. And I think it's super, super needed. Um, I'll say that that type of approach to work as a lawyer, it's not only as like a early associate, it even applies to partners representing companies that are going public, for example. You have to draft S1 registration statements for a company that's going to IPO. So much of that process is formulaic. It's taking a form and updating it for a new company and carrying over a lot of formulaic language that I don't think as knowledge work is that valuable versus thinking about the nuances of the business that's different from the prior business, right? So I do think AI could really take a lot of work off the table for law firms, corporate law firms at every level.
Yeah, no, I totally agree on this one. I was having the same exact conversation this morning with a couple of people working in traditional banks, coming back to me saying, "Okay, I was doing this in the beginning of my career, mostly working at a management consulting company. So they were mostly making, slides on PPT, of course, and they were saying, okay, maybe I was learning 5% of the time, and right now you have no reason to pay someone to actually do those kind of slides because you have, ChatGPT, Claude, and everything else to actually do it for you. And from one point of view, you spend a lot of money. From the other side, there's no one actually teaching those junior bankers and junior lawyers to how to do their work right now, and that
Mm,
would probably going to be a problem on long term.
that's a good point. Yeah, the incentives change as far as training. In fact, the incentive might be to just not hire someone at the first year.
Yeah,
So
yeah.
it's a problem.
That's a
Yeah.
problem on the short term, and on the long term, when those senior staffers will go and will retire, it's also potentially not having anyone able to actually substitute them because there's no one trained to do that. So
Yeah.
it's actually a complex situation under that point of view, I would say.
Hmm. No. Well, maybe AI will evolve to the point where it can take those jobs by that point. So we'll
Possibly, more
see.
than
We'll
likely.
see. Who knows? We'll see.
Well, yeah, yeah, yeah. So, last question from my side, Nick. It was a very, very interesting conversation, but I would like you to leave everyone that is listening with one last advice, the kind of advice that you would give to someone that is actually, starting his first fund right now or entering in the world of investing in VC right now. So, what's your last advice to them right now, today in 2025, with this kind of environment?
Oh, Michele. I'm going to go back to something I already said, which is take the time to pause and smell the roses along the journey, because it is a journey that is rewarding. It's not the end result. I learned this the hard way in life, and
Mm,
I actually think a lot of people who end up trying to do something different, to start a fund, to start a company, that relentless drive usually comes from some sort of, hard past of some
hard
sort,
journey,
whether
yeah.
it's something from childhood or their career or whatever that really just kind of rub them in a way that forces them to have to prove something different now in their next chapter. And I would say that that type of drive can sometimes take you out of the moment and just
Mhm.
constantly force you to think ahead.
Yeah.
And that is a good way to make a lot of change and to push something forward to the next level. But as an individual living a life, I think it can take years away from you as far as like being able to just enjoy what you already have in the moments that you have along that way. So I don't think you can really just pause if you're trying to do something different, but
Yeah.
you can reflect. You can take moments to just to sort of slow down and just appreciate what you have. And I think that's super important for a healthy life.
Great. It's a wonderful advice, to be honest. Thank you very much.
Yeah, of course.
Again, thank you for being here. It was a great conversation, and good luck again for everything that you're doing with Sidecar.
Thanks, Michele. Thanks for having me.
Thank you. Thank you. Bye.